Welcome to the Wiser Wealth Management Roundtable. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom are my co-hosts, Brad Lyons and Matthews Barnett. Hey, guys.
How's it going?
Hey, Casey.
This is our second podcast via Zoom for quarantine reasons. I'm still decked out for Christmas back here. You guys, I guess we didn't decorate the office this year. Oops.
No tacky sweaters or anything here?
We should do that. We should have a sweater day and I can wear mine on Zoom. All right. Today's podcast topic is, are you ready for retirement? This is probably a question that people will ask. Am I ready for retirement? I'm scared about retirement. Am I going to have enough for retirement? I would say this podcast is not going to tell you exactly what you need for retirement because every single person has a unique situation. We have hundreds of financial plans on file at our firm that we've done for hundreds of families over the last year. And I would say that if we opened up each one is very unique in its own way. So we can't give individual advice to this, but we certainly can give you some guidelines for the DIYers and maybe people who are just curious about the process. So really, we've kind of broken this down into, we'll call it four categories. Matthews, I'll let you start with number one. What's the number one thing we should be looking at to see if we're ready for retirement?
A lot of it depends on kind of the lifestyle you want in retirement. If you're trying to live on the $30,000 and $40,000, then Social Security will cover a lot of that. And then the nest egg doesn't have to be as big, but then you have clients that want to live on $100,000 or $200,000. So it really depends. You got to decide, what's the lifestyle you want to live on in retirement, and then kind of break it down from there. Also, it's not really a fixed expense either. There's different expenses throughout retirement. Usually those first few years is when you're spending the most, kind of called the go-go, then the slow-go years, and the no-go when it kind of teeters off a little bit. I think Brad's got a drawing of kind of how that works.
Look, Brad's an artist now. Look at that.
Huh?
This is a podcast.
Man of many talents here, I tell you what.
This is a podcast. You're going to have to explain what you're showing me on my screen.
Well, studies have shown that as Matthew said, our expenditures during our retirement tends to be more variable than they are during our working years, represented here by a smoother line of expenditures over time. Early on, as Matthew's explained, our go-go years, we're traveling, we're going out and having fun, enjoying, retirement after pent-up years of the working years and supporting our families. We want to go out and enjoy ourselves. And that lasts for a number of years. And then as that period changes, we become a little bit more restful, maybe. Our expenditures go down in reflection of that. And we enjoy those years in a different manner. And then later on in life, our healthcare costs can shoot up. And we find that historically, studies have shown that those are very, very expensive years in terms of actual outflows. So a variable rate of expenditures in our retirement needs to be planned for.
That makes sense. And certainly with lifestyle, I've seen people in current dollars living on $35,000, $40,000 a year, and they're happy as could be. And we have other families that if they don't have $250,000, they would get really worried. So that's the reason why every plan is unique, is we all have unique things that we want to spend money on. So I'll throw in maybe we call it like 1A, point 1A, managing cash flow. I'm a big Dave Ramsey fan when it comes to debt elimination and budgeting. Beyond that, I think he gets off the rails a little bit. But his budget techniques have really changed people's lives. And retirement, so much about cash flow, money coming in, money going out. So if you can look at your expenses, but if you didn't have some of those expenses, like if you didn't have, no one should have credit card debt, especially the 18% variety. But if you don't have those credit card balances you're trying to pay down, you don't have car loans, hey, let's get wild and crazy and let's try to eliminate our mortgage before retirement. Imagine thousands of dollars a month that saves you not having to have those outflows, right? So it's really preparing for retirement is how can we eliminate debt to be able to spend our income on trips and experiences or maybe things. I think retirement is probably more about experiences than things for most people. That's a traveling vehicle or an RV or something like that.
Well, we have clients and we talk to other people who that mortgage can be a quarter or more of their monthly income or their monthly budget. So when you ask them, what could you live on, they really forget about that always being included. That's a significant burden that's released once they no longer have the mortgage payments and allows them to live off a little bit more.
Yeah, absolutely.
A portion of that, of course, is just interest that they're paying on that mortgage payment. Right. That's just money that they're giving to the mortgage holder.
Yeah, true. Well, yeah. And for some people who can't quite get to that hurdle, man, we have really low interest rates right now. So just refi what you got left over, take it out 30 years and get the lowest payment you possibly can to free up more cash flow, right? So right. There's a lot of options to do on the mortgage front. Still sticking to the cash flow theme, I think about Social Security, pensions, any other payments that be coming in during retirement. You need to figure out how to optimize those. Just because you retire at 65, 66, 67 doesn't mean you need to be taking Social Security right away. We can show you the math, but for a lot of people, you're better off waiting to age 70 to take that distribution. From if you're a full retirement age to age 70, you're getting an 8% increase per year. That adds up, especially in your later years, to have those higher payments.
And with life expectancies increasing over time, a person at age 65, or in this case, a male at age 65, their life expectancy is another 16 years. So that puts them out to age 81. So if you delay for 5 years from 65 to age 70, at age 70, your life expectancy is even beyond age 81. But you're baking into your payment, if I can say it that way, that 8% per year increase from 65 to 66 to 67, 68, 69, and 70, that then you'll receive all the way through, the rest of your expected normal lifespan.
When we run those projections, it's usually, late 70s is the break even. Some people say, well, I paid into it, I want to go ahead and get my money. But even waiting, that the break even is usually in the late 70s. So it can make a significant difference from the late 70s into your 80s.
So we add up Social Security, we add up maybe a pension, and then we look at our portfolio. And this kind of takes us into, from a cash flow standpoint, what's your inflows? So how much can the portfolio generate for you? We talk about the 4% rule sometimes, where that's a good gauge to say if you have $1 million saved up for retirement, then you can draw down 4% of that per year.
As a rule of thumb, depending upon the actual circumstance. But, throughout our working years, we're accumulating our portfolio where the primary purpose of that portfolio is to grow in size, to maximize the return at any given level of risk. But once we go into retirement, the primary purpose of the portfolio changes. It changes from growth really to paying income. So the key at this point in time is to create a portfolio whose return stream can match the expenditures of the retiree, plus count in inflation year after year. And so it's a different thought process in retirement where you want to create a return stream that matches the required rate of return for you to have a lifelong stream of income. All right. And we do that here simply by matching long-term capital market assumptions to each asset class, equities, fixed income, and cash, relative to the person's risk tolerance and what they were required to meet in retirement income needs. It's not magic, but what it is portfolio construction to match a person, an individual's unique lifestyle that Matthew's talked about earlier.
So two ways you could look at that. It's your guaranteed income, your Social Security, your pension, plus the 4% roughly from your investments. That could be your inflow. Or if you're saving for retirement, you just reverse that 4% divided by the number that you want in income for retirement. And that's roughly what you need to have saved, right? So I think there's a couple of things while we're here. We're into point 3 now, portfolio management and retirement, that we have to think about. One of the things that I feel like it's starting to be unique to our firm. I'm seeing less firms that are doing this the way that I think that they should, but it's establishing a cash bucket. So when you're living off your money, your portfolios every month, you establish inside the account, you're establishing maybe a 2-year or a 3-year, if you want to be really safe. How much money is that portfolio generating you? That 4%, you need to have 2 to 3 years worth in savings that you pull out of that account every month, meaning cash or cash-like product outside of the portfolio, but still inside the same account, right?
Absolutely. And we saw the need for that this year in extreme circumstance. In late March, where the market had hit its low, and for people who were withdrawing money to supplement their income, we did not have to disturb the portfolio at that point in time. Because if we had, we'd have been selling assets at their low point, which would have required us to sell more shares to get that same amount of income. By having the cash bucket, a couple of years worth of income set aside, we didn't have to disturb the portfolio, allowed it to come back to pre-COVID levels in many cases, and we can make new decisions about the cash bucket going forward.
That allows you to be invested too. I think a lot of times retirees think, they retire, that's it. Now they can become conservative, and that's the end of their investing career. That money is still lasting them from 65 or so to try to plan through age 95. Being a fixed income environment, especially this low interest rate environment, that's just not going to cut it to keep up with inflation. So having that cash bucket allows you to still invest in a diversified portfolio that has not taken on too much risk, but has a little bit of equity positions to it.
Yeah, I mean, really, you stop working, but your money's starting to work even more so for the next, over the next 30 years.
Right.
What's the old saying? There are two sources of income: people at work and money at work. Not right now. We're talking about money at work, and it should work. It should go out and work for us, work hard for us as we did for it.
It allows us to be a little more aggressive with our portfolios too by having a cash bucket.
Yes, it does. And it creates a tremendous amount of peace of mind for the retiree, knowing that for the next 2 years, they've got that income secured.
So we know that we got to determine what our expenses are. We know our income is going to be coming in through guaranteed sources plus our portfolio. We know approximately how much of our portfolio can be generating based on the 4% rule. We also have kind of have to look at asset allocation. You touched on that, Brad, where, are we going to be 60% stock, 40% bonds? Are we going to be more conservative than that, more aggressive than that in retirement? You have to determine the volatility that you want inside the portfolio. And that's obviously, we like low cost index funds. You can do all this inside a Vanguard account if you wanted to, in super cheap, low cost funds. But I think the last bit of this is thinking about what you're going to do for those that are in retirement or on the verge of retirement. What are you going to do in retirement when you're done working? You walk away from the job. Some people are sad to leave. Some people are excited to leave. Some people have already left mentally from their job. But you just can't go and then not have a purpose. We've seen people who didn't have a purpose, and it's weird how like health issues and things will kind of creep in. Maybe there are underlying issues already. I don't know, but it just seems like the people who retire and leap into something, it could be just be grandkids. It could be that travel list. It could be the reading list, but there's something, it could be part-time work or volunteer time. Just find something you can engage yourself in post your working years?
Well, it used to be thought of as somebody retired and they went and rocked on the front porch, but anymore, 65 is it's just not that old. Health and medicines and wellness has gotten us a long ways down the path where people in their 60s and 70s are very active these days, and we should take advantage of that. And through our financial planning and help, we want to help fund that for people.
Absolutely. Well, I think those are some good tidbits. Unless you guys have anything else to add, I'll just say that one of the key things I think is required for a successful investment is a good financial advisor. I see that during COVID as well. We saw people who were not using our services and they went to cash. They panicked, didn't know what to do, and they didn't get back in during this COVID sell-off. And it breaks my heart to see that, because that's not the kind of behavior we need to have to be successful investors. And we have whole podcasts on investor behavior, obviously, but you got to have a trusted advisor or a guide along that way. And if you're listening and you don't have that, we're here to help. I'm happy to help you. I think it has to be done from a fee-only standpoint. I learned in another call I was in earlier this week, I thought we were 8% of our industry. I thought only 8% of advisors were not selling product. We're just here to give advice in the best interest of the client. I heard it was 2%. 2%. That's what I heard. And then I went to where I heard this from. I went to the website, and they were advertising on the website as 2%. And so I got to do my math on that. I did registered advisors that were not licensed with a broker dealer, and that was 8%. So maybe I did my math wrong, but that's a really low number. So hopefully we're easier to find than we were 10 years ago. But it just goes to show you how upside down this industry is.
Well, that can be the case. It's built on incentives, and we're incented to provide objective advice.
That's the way it should be. We need somebody powerful in government to make that the case for everybody, but that's not going to happen. Lobbyists have too much power. So those insurance companies have a big incentive for us not to work in their best interest, right? All right, guys. Merry Christmas. See you on the other side.
Merry Christmas. See ya.
Weiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.